New Zealand CAD. Alright. I don't know about this forex pair, New Zealand dollar against the Canadian dollar. I don't have any data prior to February 2, 2015, so that gives me about 3 years of data. I don't know what's up with that. Anyways, let's start by identifying major trends. Here we have some clear resistance and support. Right now we have this shorter term support. Right here we had a level that was a little lower, and here even lower. But right now we're going to look at sorry. I'm going to keep this one here. Let's look at this scenario here. Right now we had one, two. Hard to tell. It's a breakout. There's not a lot of candles, so I don't like these small bases. 1, 2, 3 months. This could maybe be a breakout candle, and maybe not an A++ I would have played, but a pattern nonetheless. I would have liked to have the test closer to the breakout line of that .90 resistance line, and add to target. You would have gotten in here at the 90.65, sell stop .8859, and your target would have been reached the following month. And what's happening here is a few months back. Let's back it up, black space for me to think, and let's just go back here. Right here we had another consolidation formation, and now we know, because hindsight's 2020, this was a top. Nice range. And notice all this again, these wicks. This is what I call noise. This is the intra candles, intra weekly, intra daily candles that played around here, that bounced through this sunk, if I could use the word that one of my viewers coined. It sinks in through that hard line, which we think it's a hard line, and after that it bounces back towards what the actual resistance or support is. Gotta let time for the market to place in the orders. And the monthly candles, I believe, give it enough time to eliminate the noise, to have false whipsaws. Because if you go back on the weekly, I like doing this, but even here, this one here, maybe this one here, all noise. Let's go take a look on the weekly. I always get sidetracked, and you see it right here. So breakout candle here. On the weekly, you would have your breakout levels would have been here. I'm not sure if you would have put, yeah. So let's just do it here for the fun of it. So you would have had the breakout candle, and I don't know, you would have maybe got you could have reached your target. Depends, I guess, where you would have drawn it. But if this is a breakout candle, I'm not sure you would have went in, because this is your risk. Your entry is at the top of the close of the candle. Your sell stops at the bottom of the wick. And I put my sell stop at the bottom of the wick because that intra noise is still buying and selling, and which could trigger me out. So you want to be on the outside of that extremity, because that's action that will happen or has happened. Sorry, the wick. You have to account for that. To the close and the opens of the candles, like the body, to draw out your resistance and support lines, and your chart patterns, and especially your breakout lines. That's all there. That's why that's why you need to have the real or the best resistance line, like the best drawn line, because that's where you're going to play your breakout. You want to make sure you're really using that the most valuable resistance, the strongest resistance, because when it breaks out, you want to make sure you're going to ride fast towards your target. You don't want to keep moving sideways because you chose a level that was above the or below the real resistance line. Let's say you thought the resistance line was a little lower, then you get in. It's a breakout, but you might just have some sideways action, and you could have bounce on the actual resistance, and then get whipsawed back out. So that's that. And yeah, so the risk, it was a 1, and the reward like maybe 0.5, probably not when I've played it. And price reverted, went back down. Right here you could see there's another pattern you could have played. Because let's say you're on the weekly, it's crazy. Like this is weekly. With daily, sometimes I use that as an example. There's even more whipsaws. Let's draw an arrow. And you could have said this is a maybe not a head and shoulders, but maybe left shoulder, head, and here right shoulder. All right, let's remove. I want to keep those lines for now. You could have said this is my measured move. Create parallel line, and you want to say, wow, nice risk to reward. Stuff to look out for here. There's a wall. Previous resistance turns support. So what I like about this target, it goes below that. So you might run into some congestion before reaching your target. Either case, what you could have also done is taking the shorter target pattern. Well, yeah. That's pretty much the target you would have had. So what you do now, you cheat. So let's say this is the pattern and this is the implied measured move, and you see there's a wall. It's okay to cheat. You're not cheating by greed. You're cheating to be on the correct side right there. Would have moved it up to be right above that. It reduces your risk to reward. But like I say, it increases your probabilities of reaching the possible target, and that's what you want to do. You want a high success rate. The higher success rate, the less you have to fetch. You have to do Hail Marys for those higher risk to reward. The higher risk to reward. So it's like always that, right? Let's say at the beginning you're looking for risk to reward 3 to 1, but your success rate, it gets worse and worse because you're not adapting your targets to be on the good side of walls, of turbulence you might have on your way. You're not drawing your lines with the monthly cancel charts to eliminate whipsaws. And then you just keep digging yourself into a hole. And what you might be doing after that is, since your success rate is going down, your success to target, let's say it starts going down, then you're approaching 25%, you're only getting 1 trade out of 4, you're hitting your target. Then just to be even or have a net gain, you'd have to increase the risk to reward. So you're always going to start maybe cheating on the candles, putting your sell stop a little closer. So when you enter, you have less risk, and then you could adjust your size, have a larger size to be able to have a higher risk to rewards. And the more you do that, the higher the risk to reward, I believe the less chances you have to reach that target. And it's like a vicious cycle where you're going for Hail Marys and bigger Hail Marys, and after that it just becomes crazy gambling. So what I try to focus on is I put everything, my trading framework, to lower the necessary risk to reward ratios, and increase my probabilities of having successful trades. So that's what I try to do. Put everything to have a successful trade, and try to get it at like the 75% area. So I don't need just even with a success ratio of risk to reward of 1 on a monthly chart. If you have a 75% success rate, is more than enough to have a net gain. All right, so now you see on the weekly all these false breakdowns. It was never reached, not even close. The price went down, reverted, and just after that it would have got triggered out. You could have thought this was another breakdown here, breakdown candle, price reverted, went back up, etc. Got to be careful with that. And it happens over and over. Same thing here. You think you have a breakout. Depends where you draw your lines. If you would have drawn it here, you would have not reached the implied measured move. Always take the closer target. So even if you're on a smaller time frame, this is what I do is take the closer pattern to the breakout line with the shorter target, closest target. Increase your probabilities of reaching the target. Smaller risk to reward, but higher probabilities of reaching that target. And the higher probabilities of reaching your targets, the less you'll be stressed about having to find these 3-to-1, 6-to-1, 8-to-1 ratios to be able to do a net gain on your NAV. See, maybe false breakout here, noise below the breakout line. All right, so price line action went down. Let's go back. That was a little me going off track. And this is the move that we had. I think there's a breakout right here. Target was reached in the following month. And the price is approaching the swell. Previous breakdown on support turned resistance. And right now it's going to have to fight right here to be able to reach the upper trend line to complete a pattern. Maybe the next bullish pattern is going to have to come here eventually. Add some candles. Now let the chart morph. Don't force anything. This might be the bullish scenario, the greedy bullish scenario for New Zealand CAD. Ooh, there you go. Do like that. Or maybe if you don't get greedy, maybe if there's 5-6 candles here, maybe I'll just have a measured move from here to the breakout line and have a closer target. And that closer target, oh, not copying. There's this one. A closer target means a higher probability of reaching it. And that's probably what you're going to have to do. All right, put an alert here on this important resistance at the 96, about the 96 level. Put an alert here for the breakdown level at the 88.25 level about. And right now, I see price action is right in between both of those. So the target was reached here, nothing else to do. And just a question of waiting it out, having more candles move along. But this is very interesting. I like it. I think that's good for the New Zealand CAD. All right, so be careful and see you soon. Ciao.